Alex Mozet, and welcome to Winner Take All. We're talking about the constant battle between large tech monopolies and traditional incumbents. So today, first topic, fun topic, and a cool topic. I like these space stories. You know, we talked about what Elon is doing with his Starlinks on maybe a couple episodes ago, and what recently just came out was that NASA's spacecraft here has actually grabbed dirt off of an asteroid, this asteroid called Bennu. They managed to get this dirt, actually, you know, have the spacecraft has been orbiting around this asteroid now for a couple of years, just taking photos of the surface to try and figure out what is the best landing spot. And then after a bunch of analysis has been done, they now gave directions. It takes 18 minutes to send the directions to the asteroid because the asteroid is so far away. So the spacecraft autonomously navigated itself to then basically kind of hover down to the surface. Then they have this little nitrogen gas canister that, you know, blows up the dirt and the soil, kind of like loosens it up on the asteroid. And they have, I guess, like an arm that goes in and grabs the soil off of this asteroid. And seems like it was a success. If things went according to plan today, it's called OSIRIS-REx, remains on course to depart Bennu in March of next year, 2021. Collected samples are scheduled to land here on Earth in a special return capsule in September 2023. It's going to take this thing almost 2.5 years to just return to Earth. Now that it's actually gotten the, you know, hopefully it successfully was able to get these samples because it's 200 miles away currently. That's why it takes 18 minutes to send these communications to the to the spacecraft about what to do and where to go and all these things. I mean, that's pretty awesome. And the whole point is now you get the soil, you can try and learn about how did life originate on Earth? Did it come from somewhere else? Was it on an asteroid and then an asteroid hit Earth and boom, magic? Or what happened, right? So it just lots of cool things happening in space these days. This is a multi-year mission. It just so happens that a few days after the fun news about what Starlink is doing, we have some more news here about what the NASA team is doing. So congrats to them, and I hope all the soil retrieval and all that stuff goes well. A little bit better of a topic than this one, which is around GDP. And so, I was looking where we're supposed to get Q3 GDP results in the next week or so here. And obviously, the U.S. has had huge fiscal stimulus, not just fiscal stimulus, but the Fed has just been printing money. I think they have over a $7 trillion balance sheet at this point. So that's called quantitative easing. And basically what that means is the Fed is injecting huge amounts of just liquidity into markets. And that's also, I think, a big reason why you see just the stock market in general doing so well. And there's been some additional attention kind of looking at just how aggressive. Yeah, here it is. The Fed's balance sheet hits new record highs. QE takes a spotlight. The Fed's outright holdings of U.S. Treasuries and mortgage-backed securities is now at $6.56 trillion. Wow. Now, this is on the Fed's balance sheet. The Fed basically has technically an infinite balance sheet. When you rewind the clock and we look at, what the Fed's balance sheet was for, pre the 2008 crisis, it was nowhere near $6.5 trillion. I'm going to pull it up here. This is their total assets. You can see here a spike in 08, 09, with the crisis 12 years ago. And then see 2013, 2014, and then 2015, it started to kind of level it off. This is what you call QE, or quantitative easing, or quantitative tightening. So are they kind of putting more liquidity out there, or are they bringing back liquidity? So now we're around $6.5 trillion. If you look now back here pre-2008, they had less than $1 billion of assets on their balance sheet. So there's just a monumental rise here in just cash and liquidity that the Fed has been injecting into the system, which certainly directly correlates to stocks and how the market is doing. There's really no end in sight, at least from what they've been signaling here. This is a good one here. It's another good chart. So you can see that, 2016, 2017, where it leveled off, then it actually started to decrease, tightening. So 18, 19, they were actually tightening the balance sheet, which is a good thing, right? Because essentially, if you think about what kind of, ammunition do they have, this easing is going to help stabilize the market and bring more liquidity. So they're essentially just like, for example, if you are increasing the interest rates, right? What the Fed says is interest rate, as they increase that, then they have more ammunition in their repertoire to use by lowering interest rates when a crisis, or in this case, a pandemic hits. Now they've gone just full on easing, and we're off this chart entirely at this point. This level of stimulus, both from the federal government providing trillions of dollars in aid, we had the PPP program, we've had checks given to people that are unemployed. We've had, a variety of different federal stimulus programs, and the Fed and the federal government have actually worked in tandem to put a lot of these programs into place. It's for another episode. It's very interesting how they've gone about doing it. Anyway, long story short, U.S. has had unprecedented stimulus, both at the federal government level and at the Federal Reserve level. Certainly, I would say well beyond what the EU has done. The EU has also been taking activity at the central bank and at the the EU has passed stimulus at the EU level. But when you look around and you just go on Google and you try and say, hey, what happened to the US GDP in Q2? This is the featured article on Google. So I clicked into this US GDP Q2 2020. It says it decreased 34%. I'm just like, oh, wow, that's not good. 34%. That's a pretty big decrease, right? Then I go and look up what happened to the EU. And then, boom, here's the top article for the EU. That their GDP went down 12%. Or roughly 12%. And they, you say, well, that doesn't make sense. Why? How is the US going down over 30%? The EU is going down 12%. And basically, that's because if you just go in on Google and you kind of punch this stuff in, it's actually completely misleading and it's actually wrong. I mean, that's not true. There's just different ways. These reports that 30% is looking at something completely different than an apples to apples comparison to say, hey, relatively, how have these economies done in Q2? And then, now we'll see if we can, as different states and countries have slowly started to reopen, what will we see in terms of a bounce back? What level of bounce back will we see? Now, this article, much harder to find, actually does a pretty good job of doing an apples to apples comparison. And what you see here is that actually the US GDP growth rate in Q2 was about 9%. So negative 9%, right? So negative growth rate. Okay. 9%, very different than 34%. Compare that to Germany, which was a touch under 10%. And actually China, interestingly enough, here at 10%, which, I mean, who knows how to believe that number? But anyway, the reported number is negative 10%. And so basically the EU zone is actually roughly that 12% number that I was just showing you. And you have the US at 9. So interesting to see Japan here at roughly looks like 7, and Australia the lowest amongst the countries in this analysis. So it'll be very interesting to see what the rebound does. But in terms of that Q2 impact, if you're comparing the U.S. and Europe actually had about a 30% greater decline in their GDP growth rate, negative growth rate, that is, as compared to the US's decline, right? US at 9, EU at 12. I think some of that has to be attributed to the just insane level of stimulus and quantitative easing and all these protocols that have been rolled out by the Fed and by the central government and the central bank. It's just unprecedented the amount of programs they've put into place in short order. So now, the proof is always in the pudding. And the pudding will come out in the next couple of weeks here when we see, okay, so maybe it slowed a little bit of the decline in Q2, but how much of this is actually helping to accelerate a rebound in Q3? Hopefully that's the result. We'll see what that result is in the coming days and week or two here. So, you put that all in context. A couple episodes on the show, we were talking about the state of the VC industry, startups getting funding, and so on and so forth, and that first financings have continued to decline. Overall, actual investment into startups has actually stayed very strong, but first financings have continued to decline. I think you're still seeing a lot of startups that are having a challenging time raise capital. But now you've seen capital go into different industries and benefited from some of these new digital behaviors that are coming out of COVID. The last topic here is actually kind of the inverse story, where not related to COVID because of what happened with India banning all these Chinese apps, including TikTok. Snapchat just released their earnings recently and is up like 35% in the stock market. The reason why is because all the Chinese competitors were just banned from India. So Snapchat's Indian users rise 150% as growth stalls in the home market. Snapchat, which once faced a boycott in India, has more than doubled its users there in the last year, as it has benefited from, quote, changes in the competitive landscape and a stream of deals with local celebrities, media companies, and mobile carriers. So basically what happened here is Snap's growth turnaround in India also offers a window into the gains TikTok's rivals have achieved since India banned the short video app this summer. So basically, TikTok got banned. There's other, Chinese social media apps that got banned. There's about 50 of these that got banned in India. And they just went whole hog aggressive on what they're, these different tactics using celebrities to aggressively expand in India. And it worked. Apparently, they have at least 20 million users in India. And by comparison, Snapchat has 90 million daily active users in North America. So, I mean, not the size of what they have in their home market, the US and North America, but a very strong up and coming second market for Snapchat. And, I think what this echoes is a lot about what we've talked about on the show is that where you see tech monopolies competing is now less and less in their home territory. When you look at US and Chinese tech monopolies, the two biggest kind of sponsors or brewing places for modern monopolies, we've seen huge protectionism in China for outside tech companies going to China since day one of China having software tech startups. And the US now is taking a more protectionist stance against Chinese tech companies operating in the US, which I think is appropriate. We've talked about prior on the show. But where you really see where you really see these tech monopolies battling is less in either home market, US or China, and more so in emerging markets like India. and Europe. And India is a great example here about how who fills that void when one side of the competition, the Chinese side, is banned from the market. The U.S. tech monopolies are able to benefit. Now, Snapchat not really truly at monopoly status yet, but certainly a strong multi-billion-dollar content platform and communication platform in Plaid, by the way, and certainly benefiting from that. I think you will similarly see Google was also up, I think, on a similar note, because what other U.S. tech companies, U.S. tech monopolies are operating in India? Google, Facebook, and conversely, will they see an increase in usage and ads and all these kinds of things because a competitor was wiped out of the market? Now, Google and Facebook, a little bit different positioning in India and versus other, say, Chinese competitors that are there. Not exactly apples to apples between what's happening here between TikTok and Snapchat, but interesting nonetheless. And I think we will see this trend continue to play out, as we've covered on the show before, where you have the U.S. now actively asserting itself in foreign markets that are friendly to restrict the ability of Chinese tech companies, whether hardware tech, Huawei, or software tech. We just covered how Ant Financial and Tencent, from a payment platform standpoint, is now seemingly coming under scrutiny, and the U.S. is working on how it can restrict their expansion outside of China. This is the beginning of a new phase, and I think an appropriate phase when you think about how strong and dominant these businesses are, and when you have Chinese tech monopolies that are ultimately controlled by the CCP, it's a totalitarian communist government. Do you want those companies spreading their roots and tentacles into other foreign markets? I think the answer would be no. You actually don't want that. Not just the U.S., but those local markets as well. Clearly, the U.S. didn't tell India to ban TikTok and these 49 apps. India did it on their own, and actually the U.S. then followed with corrective action on WeChat from Tencent and TikTok. So this isn't just the U.S. that's doing this. I think a lot of countries are waking up to the fact that all of this data from these Chinese tech monopolies, it just pipes right back into the CCP. And in China, these Chinese tech monopolies are used to impart and enforce the CCP's will upon their people. And it's very unfortunate. And you don't want that same system repeating itself outside of China if it can be prevented. This is net, I think, a good thing, both for U.S. tech companies operating abroad and just those local markets and how those local markets are governed and influenced by foreign tech companies. That's it for us. Thanks for joining us on Winner Take All. I'll talk to you soon.